What's up everyone, welcome to Stockton. It's a pleasure to meet all of you. On this channel, we talk about stocks before they start blowing up, say goodbye to chasing stocks at all-time highs, and say hello to making some money. So if this sounds like something you want to take advantage of, then hit that beautiful subscribe button and like the video. Now let's get to it. Before we get into the video, I have to say that I'm not a financial advisor. Anything I say is just my opinion and is for entertainment purposes only. Having said that, if I'm talking about a company, I'll let you know whether I'm personally going to invest in it or not towards the end of the video. But you should always do your own due diligence, so with that out of the way, let's get started. Hi guys, today we're talking about JD.com, ticker symbol JD. I feel like this company has a lot of potential and is due a massive rebound in share price. As you can see, it's down from its all-time highs of around $92. The fall occurred due to fear over Chinese companies being delisted. However, I feel we've put that behind us now, since we know that these companies have at least a year or maybe 3 years to comply. Fact check me on that please, I'm not sure if it's a year or 3 years. So first, let's see what this company does. JD.com, through its subsidiaries, operates as an e-commerce company and retail infrastructure service provider in the People's Republic of China. It operates in two segments, JD Retail and New Businesses. However, they now also have a healthcare unit called JD Health, but that's a separate entity. JD Health is doing exceptionally well so far, and the profits from this spin-off should boost JD's free cash flow. So in a nutshell, JD.com is the closest thing China has to Amazon. Now, let's jump into the company's financials to see how they're doing. The first thing we want to see is an increase of net income over past years. As we can see here, their net income has been steadily increasing, which is a very positive sign. Okay, next, we want to see what their gross margin is like. As a rule, gross margin should increase over time. Having a high gross margin says a lot about the scalability of the business. So the gross margin, as you can see here, has increased in the last couple of years, which is good. However, when you compare their gross margins with Alibaba, for instance, you'll find that JD's gross margins aren't as good. But that's because the two businesses are very different. JD recognizes most of its revenue from the goods that are sold on its platform. It has to pay for them and thus has a low gross margin. Alibaba, on the other hand, because it never owns any of the products it sells, only recognizes its commission, approximately 5% of the value of the products as revenue. So I'm actually not too concerned about the gross margins here, and it wouldn't be accurate to compare these with Alibaba in my opinion. Now let's look at their debt position. As you can see, they have a decent balance sheet. JD's debt is well covered by operating cash flow, and JD earns more interest than it pays, so coverage of interest payments is not a concern. Now, since we talked about JD's margins earlier, I want to read an article from Motley Fool, 5 Reasons JD.com is Still an Undervalued Growth Stock. This was published on the 19th of November, and the share price at that time was slightly higher than what it is now. Since nothing else has changed fundamentally with the business, you could argue that these points are still valid. I encourage you to read this article when you get a chance, but right now I just want to touch upon a couple of things. JD's margins are expanding. JD takes on inventories and fulfills its orders with JD Logistics. By comparison, Alibaba connects buyers to sellers, doesn't take on inventories. JD's business model is more capital intensive than Alibaba's, but it enables JD to maintain tighter control of its orders and protects shoppers from counterfeit products. JD's hefty infrastructure investment throttled its earnings growth for years, but economies of scale are now finally kicking in. In other words, JD's fulfillment network, which includes automated warehouse robots, driverless delivery vehicles, and drones, now operates efficiently enough to generate stable profits. It's also generating more higher margin service revenue from third-party customers that use that massive network. As a result, JD's adjusted operating margin expanded 80 basis points year over year to 3%, while JD's retail adjusted operating margin, which only includes its marketplaces, rose 60 basis points to 3.9%. Its total adjusted EBITDA margin also expanded from 3.1 to 3.8%. Based on those improving margins, analysts expect JD's adjusted earnings to rise 53% this year. So now I want to just talk about whether this company is undervalued according to this article. Generally speaking, if a company's forward PE ratio is lower than its earnings growth, its stock is undervalued. If a company's market cap is equal to or lower than its annual revenue, it's also considered cheap. Analysts expect JD's revenue and earnings to rise by 22% and 44% respectively next year. Based on those estimates, its stock trades at 41 times forward earnings and about 1 time next year's sale. Those valuations, along with JD's impressive growth in revenue, users, and margins, all indicate it's still an undervalued growth stock. Therefore, I wouldn't be surprised if JD doubles again within 1 or 2 years. Now that's pretty good, but now I want to show you what the analysts are saying about the stock. So you should never take what analysts say as gospel, but over here what they're saying is that in 12 months, this is going to hit $789. Now, that's like 800% increase. I don't think this is going to happen in 12 months, to be very honest with you. However, I do think that it can hit at least $120 within 6 months. And I'm just saying this based off on the fact that I think JD.com has been beaten down because of the delisting phase and it hasn't really recovered yet. So we should see a nice rebound in price very soon. Currently, my average share price is around $82. I don't care what happens to the share price in the short term because I'm long on JD. As always, do your own due diligence, but personally, I feel like this could be a safe play, especially these days since every other stock is so overvalued. Let me know what you think in the comments. Please like and subscribe to the channel if you find this content useful. It really helps with the YouTube algorithm. Peace out.